Now, to narrow down on the conservative approach, we always have underwriters looking at deals, right? And there's a significant difference between a lead and a deal. LEAD versus DEAL. All leads are not deals. Considering the conservative approach, how do you identify what is considered a deal before we start actually bringing this to our investors?
Yeah, I think from a fundamental perspective, it's got to hit some of the checkings and the buy boxes on our end to make it make sense. We need to have a certain size of units for us to feel comfortable and confident to want to move forward with the opportunity. So that can mean a couple of things. That can mean unit count, that can mean return profile. But we typically speaking are looking to acquire deals just from a non-startup perspective. If it's less than $30 million, we probably aren't going to look at it anymore just because it's really time consumptive on our end. If it's sub 150 units, it probably doesn't make sense. If it's in certain sub pockets in areas where there's FEMA problems, environmental issues, if it's in a flood zone, if it's something in a manner in which there's unnecessary risks, we're not going to look at it there, if that makes sense. So those are some things that we look at. And then as far as what makes a deal, we need to see a compelling return profile on what the key thing is risk adjusted. So risk adjusted is a very subjective term in the business because everyone says their underwriting is conservative, but that may not be true. So what I mean by that is when everyone looks at a deal and when everyone has the opportunity to invest in an opportunity, they're going to see something that is going to solve for somewhere between a 16 to maybe a 19 IRR.